I'd like to talk about a concept called drawdown and max drawdown. So, drawdown in and of itself is just a measure of a decline from a peak to a trough. And we have peaks and troughs all the time. We have them throughout the day. We'll have a high and then a low, a high and a low. We'll have them over the course of a week. We'll have them over the course of a month. We'll have them over the course of a year. And what you can see here is these lines here in blue represent one particular drawdown. So if we look at this peak and we go down to this trough, that is a drawdown, right? If you're long stocks at this top point and you buy and hold, you ride this whole curve all the way down until you get down here. Now, luckily, you start to come back up and you hit a new peak and then you start to head back down. So that's a drawdown. That's one drawdown. There's tons of drawdowns in here. We can come through here and we can mark all these drawdowns. And it could be from this peak, this drawdown could go, you could measure it all the way down to this peak. You're just measuring a peak to a trough. Now, there's another concept and so the moral of that story is that you're going to have peaks and troughs all over the place. Depending on what period of time you look, you might have hundreds, dozens, thousands. But you're going to have peak to troughs all over the place. So you're going to have drawdowns everywhere you go. Max drawdown is a little bit nuanced in that it is the maximum point from the maximum peak to the maximum, or the minimum, I guess we should say, trough. You're only going to have one of those in whatever time period you measure. So here we're looking at 2022, we're looking at the S&P, we're looking at daily prices. What we can see here is that we hit a peak at the very beginning of the year. And we kept coming down and coming down. Now we do come up, but the thing with the max drawdown is you measure it from the decline of a peak to a trough before a new peak is achieved. So here we did not achieve a new peak. We have to get all the way up to this level. So we keep measuring our drawdown. We go here, we create a new peak, but not a peak that's as high as the other one. And we keep going all the way down to this little spot down here, which is our lowest spot before we get to another peak. This is what's known as our max drawdown. So if you are an investor and you're invested in S&P, you're going to ride this wave all the way down to this spot before you start moving up again. Okay? This is our max drawdown. So when we talk about max drawdown, this is the picture you should get in your head. We're going from the highest peak to the lowest trough before we create a new peak. You're only going to have one of those in a year. You only have one maximum drawdown in a year. You have a lot of drawdowns, but you only have one max drawdown. So all of that is just background as to what max drawdown is. But what does max drawdown tell us? So for instance, if we have a really big max drawdown, does that mean that we have a really bad year? If you're sitting here and you're experiencing this sort of decline, should you just throw your hands up and say, you know what, I shouldn't be investing, period. This is all, for naught. Well, what we find is that the answer to that is no, not necessarily. So what we did here is we graphed the annual so we went back 20 years and we graphed the annual S&P return for that year. And we also looked at the max drawdown for that year. So if we look up here along the x-axis, we have returns. So we go from a low of basically 40% all the way to a high of plus 30%. If we look on the y-axis, then this is our max drawdown. Now, obviously all of our numbers are going to be negative. They have to be negative. Your drawdown is always going to be negative. Now it can be a small negative, it can be a big negative, but it's always going to be negative. So we took each year and we put them on this XY sort of grid. And what do we find here? Well, we find that there was a year, 2008, where we had a huge drawdown, 48%, and we had a huge loss, right around 40%. 2008, if you remember back, was a really bad year. So if you're an investor, you're just seeing your portfolio go down, 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 down. And really in 2008, there was no hope that your portfolio would go up because overall the year was a big fat negative. Now, let's take a look though at some other dynamics. Let's take a look at the very next year, 2009. 2009 actually had a fairly significant drawdown, in the high 20s%. But it also had a really pretty robust return, almost 30%. So you can see in terms of drawdown, it really is only beaten by 2008 and 2020. So 2009 had a really pretty big drawdown, but it also had a really nice return. So it doesn't necessarily mean that if you have a really big drawdown at any given point, that you're going to have a bad year. We can see 2020, we actually had a pretty big drawdown. If we look over the last 20 years, we had the second biggest drawdown, but we actually notched out a pretty decent return that year, right around 15%. So 2020, even though it might have seemed like a bad year, obviously it seemed like a bad year for a variety of reasons, from a return standpoint, it actually turned out not to be such a bad year. So you had quite the roller coaster ride getting yourselves to over 33%, but at the end of the year, you were compensated with a pretty nice return. Now, as an investor, you sort of have to put yourself on this graph. Now, nobody wants to be on this side of the graph, right? These are returns that are negative. Nobody wants to be on that side of the graph. Everybody wants to be on this side. Everybody wants to have positive returns. The real question is, what sort of experience do you want to have? So if you look here, let's just take, for instance, 2004. Well, 2004 did not have a very big drawdown. It had about an 8% drawdown. So if you're an investor in 2004, you're feeling pretty comfortable. You're not seeing really big decreases. The max your portfolio is going to decrease in 2004 is 8%. That being said, you eked out, probably about a 5% return that year. So, it was not a crazy year. It was not a, stressful year, but it also wasn't a very profitable year for you as well. Compare that to one that we already looked at, 2009. Well, 2009, your portfolio is up and down. The downs are pretty down, but you're getting yourself almost a 30% return. So a very uncomfortable year, but also a very profitable year. And that's what you find as you move from these points that are, have lower drawdowns and lower returns, you're experiencing less stress, but you're also probably getting less of a return. Now, what do we all hope that we get? Well, we all hope to be somewhere kind of in this area of the graph, right? What does that mean? Well, look at 2003, for instance. 2003 had a drawdown of only 13%, a little over 13%. However, had a really good return of over 30%. In fact, that's the highest return we have. And in terms of drawdown, it's not the lowest drawdown, but it's also not the highest drawdown. So 2003 was a really, really nice year. It was both profitable and fairly comfortable. You can actually take this concept. So we're looking at this on the S&P, but you can take this concept to your own investments, right? The more risky you get, the more you're going to experience in terms of a max drawdown. So if you're investing in small cap growth, you should expect that at periods of time, your portfolio is really going to take a beating. But we also are going to expect higher returns when we experience more of that drawdown. So we'd like to probably be moving in this direction, right? That being said, if you are not comfortable with big drawdowns, then you're probably going to be most comfortable in this area over here. And there are asset classes that tend to live in that area. So think of more secure things like large cap value, even some mid cap value, developed large cap stocks. You're going to have less of a drawdown because you have less volatility, but you're probably going to get less of a return as well. So as the investor, your goal is to figure out where exactly you want to be on this chart. But the moral of the story, going back to our original question, should you be panicking over a bad quarter? No, because if you look at 2020, we had a bad quarter there, but we also ended up having a pretty good year. Same thing with 2009. There were periods of really big drawdowns, and overall we had a pretty good quarter. So don't panic. Think about the long term, right? If you're an investor on the long term, this is a 20-year sort horizon. If you looked at your 20-year drawdown, annual drawdown average with your average return, you're probably going to be somewhere in this area. So don't panic. Think about your time horizon and make sure you're matching up sort of your expectations with your time horizon. Here we go. One more last thing on drawdown. You can see this is performance by year. So all the same data that we just looked at, performance by year with drawdown. So drawdown is obviously our yellow bar, and this sort of greenish bar is our performance. So you can see, overall, with the exception of a few years, the S&P actually is a pretty profitable place to put your money. Most years in the last 20 years have been profitable years. 2008 was a really bad year, but even on those years that have been negative, they really haven't been that negative. Look at our most years, though, were pretty positive. So even though you have a big drawdown, there's not necessarily a relationship between a bad drawdown and a bad year.